Hey, what's up, stock compounders? Brad here. So today I want to talk about value line special situations, okay? Probably about a month ago when I started doing the weekly Corner of Berkshire and Fairfax series, what are smart value investors buying as revealed through that thread in Corner of Berkshire and Fairfax, someone suggested that I take a look at these monthly value line reports called the Special Situations Service. That sounded like a pretty good idea to me. So that's what I'm doing today. It's the first time looking at one of these monthly special situations reports in Value Line. So what I'm going to do is I'm going to pull out all of the stocks that are recommended buy or especially recommended. Okay. So let's just take a peek at what this report looks like. So, if we go down, there's essentially two portfolios, right? There's an aggressive stock portfolio, and these are done on kind of a rolling basis, okay? You can see here when it was originally recommended. You can see what the current advice is based on the price. So the options for current advice: hold, buy, especially recommended, sell. Those are the options for current advice. So I took out the buy and especially recommended from both the aggressive stock portfolio, which means it has above average growth potential. I guess that's the growth bucket for Value Line. And then there's the conservative stock portfolio, which is, probably the, so it says seeking growth and or income. So there's probably some higher dividend players in here, perhaps some companies that are more in the mature phase of the business cycle. So I pulled out the buy and especially recommended from both of these portfolios, and I created a spreadsheet here. And there were a total of 28 companies that were currently either a buy or especially recommended. Now, you guys are going to be familiar with the filtering process that I like to use. The first one is how many gurus own them, according to Dataroma. Okay, this is bowling with bumpers. I want to see that one of these smart investors who has done well for decades has put their money where their mouth is on one of these companies. The second one is Value Investors Club. Is there a write-up in Value Investors Club from a smart investor? So I wanted to see at least one of these two boxes checked. So you can see here there's a score. So really you get a point if you have a guru who owns the company as of the last 13F filings, which was December 31st, 2020. And you get a point if you have a recent write-up in Value Investors Club, and that really means within the last 2 years, okay? So you can see here the top 7 companies had both of those. A guru owned it, and it had a VIC write-up. Now there's one here that's actually a short thesis for Value Investors Club. I decided to keep it in anyway. This one didn't get selected, it turned out, because of the low insider ownership. But one of them did. One of them made it through past the insider ownership stage. So I sorted this by score. We're only looking at 2s and 1s. Have to satisfy at least one of these criteria. And then I moved into the insider ownership filter. Now, the way I got this was sec.gov, look up the ticker, find the proxy to the annual report, and see, how much of the shares outstanding do insiders own, both members of the management team and the board. So, and my threshold here was 10%. You have to have more than 10% insider ownership to move to the next level of looking at kind of some more specific financial details here. So which ones made it past those 3 filters? LGI Homes, okay, home builder in the US, passed all of the criteria at just over $4 billion market cap. We've got Upwork, Okay, freelancing site where you can hire freelancers to do, a lot of different things. I've used Upwork in the past. I've had mixed experiences, but anyway, that's the second one on the list. Pretty impressive insider ownership, the highest of any company in here. A quarter of the shares outstanding are owned by insiders. A little over 6 billion market cap. Third one, installed building products. Okay, I believe they primarily install insulation in new construction. This was especially recommended. Very recent VIC write-up. Tied for the most recent out of any of these companies just 2 months ago. 21%, very impressive insider ownership, just under 4 billion market cap. So those are the top three. They all had a score of 2, which I like to see. The next one's Health Catalyst, Limelight Networks, Cogent Communications Holdings, and Trupanion. Okay, these were the 7 companies that were currently recommended by and met those initial filters. Bowling with bumpers, smart write-up that I can read to quickly kind of understand the bull case for the company, which obviously isn't the only thing I want to understand. I want to understand the bear case as well. And then insider ownership. How well am I aligned if I decide to become an investor with the management team? So let's get into a little bit of the details here, because that's where the fun is. So net debt, okay, to operating income. This is one of the ratios I look for. How quickly could debt be paid off from operating earnings? We've got 1.4 years for LGI Homes. That's pretty reasonable. I think anything under 3 years is acceptable to me. That's kind of my threshold. I kind of picked that up from Phil Town just to give him a plug. Acquirer's multiple, 13. So the acquirer's multiple is really enterprise value divided by EBIT, earnings before interest and taxes. So 13, I think is pretty solid. And then especially when you look at the revenue growth of 24%, that's a nice kind of combo of fairly cheap with the 13 acquirers multiple and pretty nice grower at a 24% annual revenue growth. So LGI Homes, I'm impressed with. If I were into home builders, I would take a deeper look at LGI Homes. Not super interested in home builders personally. It's not an area of competence for me. But if any of you are, take a look at LGI Homes. The next one, Upwork. Let's see how the numbers pan out. So net debt minus 135 million. What does that mean? It means it has a net cash position. Okay, more cash than debt on the balance sheet by 135 million. So that's great. Operating income minus 22 million. So let's actually take a look at Upwork. I want to see what the trend is for this operating income. So this is ticker terminal that I'm using here. It's beta version, invite only. I can send you guys an invite if you're interested in getting into ticker terminal. So let's go to the financials. And ticker terminal is really great for companies outside of the US. If you want to look at income statement, balance sheet, there's a lot of great financial info that's presented in a really digestible format. So highly recommended for that, where it can be hard to find reliable data in one place for companies in different markets. So we're going to go to the financials, and I want to look at the history of operating income. Okay, we can see pretty nice revenue growth here. It's more than doubled in the last 4 years. Operating income has always been negative, okay? And 2020 was the most negative that it's been in the last 4 years. So not something I really like to see, that it's never had a positive operating income. Obviously it's a young company, it's a growing company. But personally, I like to wait for a company like this to show me that it's in the black for a couple of years and that it's on the right track. So I'm happy to wait for Upwork. I don't need to jump in when it's still losing money. So that's my position there. Next one, installed building products. Debt, operating income, 2.4, a little higher. It's under 3 still, but it's getting close to making me a little bit uncomfortable with the level of debt there. Acquires multiple 26, a bit high, depending on the growth. So let's look at the revenue growth for IBP. IBP, installed building products. We're going to the financials, the income statement. So revenues, okay? Now you can see here change year over year for revenues. 30%, 31%. That's phenomenal. I really like that from 2016 to 2017. And then you get 18%, 13%, 9%. So the change in revenues are going down. Okay, still positive, but I don't like this trend over the last 3 years or so. I'd really want to understand that. And honestly, it's I can just take a pass on it, seeing that. I don't need to look further. So that's what's happening with installed building products. Now this may just be a natural, kind of normal, cyclical thing that we're seeing within this industry here. I don't know enough about the industry of installing insulation. Installation of insulation, waterproofing, fire stopping, fireproofing, garage door. Okay, so they do a lot of things there in terms of new construction. But yeah, I don't like that revenue trend. So I'm gonna just skip over that one. Next one, health catalyst. All right, so we have a net cash position. Okay, we have negative net debt, but the operating income from the last 12 months is minus 78 million. Okay, so in 1 year, this net cash position is gone. Let's just take a look at what the trend has been for the operating income. At the financials, operating income. So we're going down, guys. The last 3 years, okay, operating income, we're negative, we're more negative, we're more negative. We're just getting more negative, which is really not something I like to see. So solid revenue growth, 37%. You can see that on the top line here. But I'm not interested in looking at this any further. And I have no understanding of this industry, quite frankly. So next, we're looking at Limelight Networks. Okay, this is the one that had the short thesis in Value Investors Club. Net debt, it has a net cash position of 9 million, but it lost 14 million in the last year. And this revenue growth is only 8%. Okay, so right there, I'm gonna take a pass. Next one, Cogent Communications Holdings. Net debt, operating income, that is a big delta. Okay, almost 8 times as much net debt as operating earnings over the last year. So that's just too much debt for my comfort. I don't really care what kind of debt it is. I'm taking a pass there. And you look at the acquirers multiple, 38. You look at the revenue growth, 6. I want to see those flipped. okay? I want to see a low acquirers multiple and a high revenue growth. And that's just not what we're seeing there. So lastly, Trupanion, okay? This is kind of an interesting company. We've got a net cash position, lost $4 million in the last year, but there is a lot more cash than there is losses from operations. So this could be worth looking at. 28% revenue growth. That's pretty solid. Let's look at Trupanion. First of all, what is Trupanion? Provides medical insurance for cats and dogs on a monthly subscription basis in US, Canada, Puerto Rico, Australia. That's kind of cool. Obviously, it's a recurring revenue model, monthly subscription. The insurance business can be tough. You've really got to be smart when it comes to insurance. If you get greedy, you can really get burned. So it's not an area I really know anything about. But let's look at the financials real quick. So revenues, I mean, great growth there. Fantastic. Very consistent too. You look, we're between 25 and 31% over the last 4 years in terms of revenue growth. Operating income is negative. The company's been around a while. It's been around, at least 9 years. So I don't know, guys. I want to see some. When are we going to see some positive operating income here? Again, I don't know anything really about the insurance industry, so not exactly sure what to intelligently look for here in terms of trends. Like the revenue trend, not crazy about the operating income trend there, or at least the raw numbers. So that's an easy pass for me as well. So really the only one out of the 20, how many was it? 28 companies that were recommended by or especially recommended in value line special situations is this LGI Homes. And that's okay, guys. I mean, this is 1 month. If I can find one company each month to dig deeper into from a service like this, that's fine. I don't necessarily want any more than that. To be honest, I really only want 1 or 2 compelling investment opportunities each year, okay? So you might look at this and think, well, you didn't get a lot out of digging into this special situations report. But that's not necessarily true. Remember, Charlie Munger, I think, read Barron's every week? It might have been every week for 50 years. And he got one stock idea out of Barron's that he acted on. And it was a fantastic investment for him. So, it can be a lot of work to find the gems. So, I'm not fazed by this. I think I'll do this again next month as well for the May 2021 Value Line Special Situations Report. I just wanted to read real quick from this report. What did they say about LGI Homes? Because they actually did give a little bit of a write-up on page 4. So let's see what they said. LGI Homes has been on an impressive run over the last 2 months. There is a chronic undersupply of new housing and seemingly strong pent-up demand. We are now even more bullish as the secular tailwinds ought to benefit the home builder. Millennials are entering their prime age for buying a home, and LGI Homes builds homes at the ideal price for first-time buyers. Potential legislation or an executive order on some form of student loan forgiveness would be a significant catalyst for the market that is not currently pricing in such a move, in our view. So that's interesting that they noted that. Obviously, all of these students saddled with all of this debt, if that got forgiven, they'd be in a much better financial situation to buy a home. This isn't really part of our optimistic outlook. That's good, because who knows what the probability is of that student loan forgiveness actually happening. Of course, lending standards have tightened and input costs have risen, namely lumber prices of late. However, the secular trend is more powerful than any concerns about cyclicality of the industry. We recently upped our 3 to 5 year earnings estimate by $1.50 to $16.50 a share, and our price to earnings multiple to 14 times. Consequently, we increased our price target to $230 a share. While this stock is still liable to a drawdown should the broader market soften, we believe it is still a buy even at these levels. So again, I just want to take a quick peek at what the price history has been, because it has just been gangbusters this year. You know, when they're talking about how well it's done over the last month, it's like, okay, what has it done over the last year, right? So it's up 3.7 times the price of the stock over the last year. So it has gone gangbusters. And remember that price target of $230 per share. We're at $168 right now if I move this. So $230 per share, I'm not totally sure. Is that the 3 to 5 year price target? Because if it is, that's a long time to wait for a 30-some% appreciation in stock price. Okay, so you know, not super compelling if that's their 3 to 5 year price target. But again, I like the numbers based on, you know, there's a guru that owns it. There's a VIC write-up. There's over 10% insider ownership, $4 billion market cap. I'd want to get a sense for, you know, what's the total addressable market there? How much can they grow from their current size? But the numbers look good. Okay, so that's one to dig into. If you guys, for any of you home builder experts out there. So anyway, guys, hope you enjoyed this breakdown of the latest special situations report for Value Line. Let me know in the comments if you want me to continue doing this each month, if this was of value to you, and I'll keep it going if that's the case. All right, guys, I will see you all in the next video. Take care.